All right, welcome back. Last time we were talking about, or we concluded deferrals. Again, this is the accounting cycle, step 5, and then we're talking about adjusting entries. I believe this is part 5. Um, don't quote me on that. But anyways, we're talking about accruals. Accruals. So this is the other type of adjusted entries: deferrals, postponements, accruals, advancements. What are we advancing when we are talking about accruals? As far as revenues, we are advancing um, the performance obligation. We have provided the service or we have delivered the product to the customer, but the customer has not paid us yet, okay, at the conclusion of that artificial time period. For expenses, it is just the opposite. We have used or consumed that expense, but we have not paid for it yet. Okay, so for expenses, the cash is not exchanged, even though we used the expense. And for revenues, the cash is not exchanged, even though we have provided the service or delivered the product. Okay, you see how that works? Great, just the opposite of deferrals, right? And this is just repetition, but we have some examples. Again, rent, services performed, interest, accrued revenues. So for accrued revenues, which is what we're going to tackle first, okay, let's take a look at an example. Actually, before the example here, again, it affects on balance sheet account and it affects an income statement account, okay, for revenues. Um, so we'll see how that works, okay? We'll see how that works through an example. In October, Pioneer Advertising Inc. performed services worth 200 that were not billed to clients in October. That were not billed to clients in October. So on October 31st, here is um, the entry. Okay, here is the entry. Not billed. That means it's going to be on account. It's going to be on account. So these are services that we have provided, but the customer has not paid us yet. So when that happens is, um, instead of booking it as cash or debiting cash, you would open up an account for these individuals as an accounts receivable. And then you would credit service revenue. Okay, you can book service revenue in this case because you have earned that money. You have earned that money. The customer just has not paid you yet. So that is that adjusted entry. Okay, that is that adjusted entry at the end of the period. In this case, October 31st. Okay, October 31st. Then, when it comes time to for these customers to actually pay, when they actually pay you, so in this case, on November 10th, Pioneer receives cash of 200 for the services performed. Then you actually debit cash, which is what it should have been originally, and you credit accounts receivable because they no longer owe you that money on account since they paid you cash now. Okay, so you don't have to have an open account for these individuals since they paid you cash, and it's for the same figure, the 200, 200, and that's all she wrote. Okay, we do the same thing, analysis, basic analysis. The asset account, accounts receivable, is increased 200, and the revenue account, service revenue, is increased by 200. Assets increase 200, service revenue increases 200. There we go. The accounting equation is still in balance, so we are good to go. Debit and credit, again, debits on the left side, credits on the right side. Debits increase assets, that's why we debited accounts receivable. Credits increase revenues and liabilities, that's why we credited service revenue 200. And then we had the journal entry, and then we post to the ledger. In this case, it's T accounts, just to keep it simple. Accounts receivable, looks like that was the first entry for accounts receivable. So we just had that just an entry, 200, and then the balance is 200. Debit, good. And then service revenue, looks like we had from before. Remember, we're keeping, if you're watching the other videos, we're going with these same examples for Pioneer Inc. 10,000 originally, then the 400 for one adjusted entry. That was a transfer of unearned revenue. And then here we have this adjusted entry, which is for accruals. It's just booking it as revenue because you're expecting to receive that money from these customers, okay, regardless of when they pay it or not, whether they pay it or not, but you've earned it, okay, so you have to book it. And then the balance is 10,600 in this case, and that's all she wrote. Okay. Accrued revenues, examples, interest, rent, services, and then reason for the adjustments. Reason for the adjustment, it just, you performed the service, you performed it, and they haven't paid you yet. Okay, they just haven't paid you yet. So the reason for the adjustment is just that. You have to do this adjusted entry because if you don't, then your assets will be understated and your revenues will be understated for accrued revenues. Okay. Again, your assets will be understated and your revenues will be understated. In this case, because it is advancement of the performance obligation, it's an accounts receivable. Accounts receivable that is debited in the adjusted entry. Accounts receivable is debited in the adjusted entry, and then the revenue account is credited in the adjusted entry. Whereas deferrals for revenues, it was a liability account that was credited, and it was, or sorry, it was a liability account that was debited, and then service revenue that was credited. Okay, so that's the major difference. And then we had just a journal entry. Assets are debited, revenues are credited, and that's it. Okay. Here we have examples of accrued expenses, or we're moving on to accrued expenses. Accruals are simpler, I think, than deferrals, okay? Because deferrals, you have depreciation and all this stuff, and it gets a little bit confusing, and that's not good, okay? So now we have expenses. Expenses, accrued expenses, okay? Some examples are interest, taxes, salaries. So what happens is you consume or use the expense before you actually pay the cash. Okay. Again, it's accrual accounting. Cash does not have to be exchanged at the time. Okay. So let's take a look at an example. Here, where there's this example where we haven't talked too much about, but hopefully this can be just simple. Pioneer Inc. signed a 3 months note payable in the amount of $5,000 on October 1st. The note requires Pioneer to pay interest at an annual rate of 12%. So this is a short-term liability, and it's a notes payable. It's just like an accounts payable, except you actually sign it. It's like an IOU. I promise to pay you this 5,000 plus an annual interest rate of 12%. Okay, so don't forget that these interest rates are stated annually for notes payable. Okay, but we only are borrowing it for 3 years. Okay, so we're borrowing this money, or sorry, 3 months. 3 months. So we only have to pay interest of 3 months. Okay, and then the principal gets paid at the conclusion of this note. Okay, but the interest keeps on accumulating. The interest keeps on accumulating per month. Okay, so to calculate the interest, you take the face value of the note, which is 5,000 in this case, times the annual interest rate, always multiplied by the interest rate first, which is 12%. And then you multiply that by time in terms of 1 year. Time in terms of 1 year. So in this case, it's 1 divided by 12 because time in terms of 1 year, it's 1 month, okay, that's expired, okay. At the end of October, it's 1 month, so 1 divided by 12, which equals $50. So that is your accrual of this interest. Okay, so your adjusted entry would be interest expense, and then you would open up a liability, interest payable. Now, interest expense is going to go to the income statement. Interest payable is going to go to the balance sheet. Okay, so that's your accrual. And then when you come to actually pay this, then you eliminate the liability, okay, because you no longer owe it. Okay, the interest is paid at maturity, so you no longer owe it, that interest payable, and then you will actually just be paying the actual cash for this interest. Okay, for this interest. So that's that. Okay. The analysis, still do the same analysis. Basic analysis, interest expense is increased because it's an expense. Okay. Um, $50. The liability interest payable was increased $50. So in this case, liabilities increase $50. And interest expense increased $50. Now, don't get confused by the negative under the interest expense because they're talking about the totality, okay? The whole elements. So, even though interest expense has increased, it's going to be subtracted from the totality of stockholders' equity. The payable is going to be added to the totality of liabilities, and so forth. You get this. We've been over multiple videos now. Okay. Debit credit analysis. Debits left increase expenses. Credits right increase liabilities and stockholders' equity. Following the accounting equation, right? So debit interest expense $50. Credit interest payable $50. That's what you see in the journal entry. And then finally, you post it. Post it to the ledger. So you have an interest expense ledger and an interest payable ledger. Interest expense just showed up on that just in entries, so we didn't have any normal transactions for interest expense. And that just in entry was debit. Then the balance is a debit of $50, and that's all she wrote. Interest payable only showed up in that just in entry, so we have a just in 50, and then we have a balance of $50, and that's all she wrote. That is all she wrote. That is all she wrote. Should be a song, right? Okay, never mind. All right. So that's one type of accrued expenses. Other accrued expenses, a popular one. Okay, this notes payable, that might be the most difficult, maybe, or one of the most difficult ones because you got to work with interest. But interest is real simple. All you have to do is just take the face value multiplied by the interest, which is stated annually. So you have to convert it to whatever you want to convert it to. If it's a month, then you take 1 divided by 12. If it's 3 months, then you take 3 divided by 12. If it's a year note, then the interest will just be for that entire year. So you just have to do the principal multiplied by the interest, and that's it. You don't even have to do the fraction that is at the end. Okay, so always stated yearly. Always stated yearly, so you have to convert it to yearly. Simple math, and we'll talk about other examples. It's going to be reoccurring. Excuse me, and you will also see it when we get into the chapter on liabilities and all that good stuff. Anyways, another accrued expense is wages. This is a popular one, and this is one of the other confusing ones. Okay, if you don't take your time and just understand it once, and that's it. Okay, so Pioneer paid salaries and wages on October 26th. The next payment of salaries will not occur until November 9th. The employees receive total salaries of 2,000 for a 5-day work week or $400 per day. Thus, accrued salaries at October 31st are 1,200. 1,200. Okay, so we have some confusing stuff going on here. Okay, but we just need to analyze it slowly. They pay 2,000 for a 5-day work week, okay, or $400 per day. That's total, okay. Don't care about how many employees they have. We don't care who gets what or whatever, okay. They just give us a total number, and that's fine, okay. Accumulated, $2,400 per day. Now, this is the start of the pay period. It's on the 15th, okay, on the 15th. So they go for about 2 weeks, 2 weeks before they get their paycheck, okay. Or sorry, yeah, 2 weeks, right? 2 weeks, 15th to the 26th. Okay. Anyways, on the 26th, they made a payment. Okay, Pioneer paid salaries on October 26th. Okay, that's when they paid it. Okay, so everybody got their check on the 26th for whatever amounts they worked. Right now, um, we skipped the 27th, right? We skipped the 27th and the 28th. We're just assuming that these individuals uh, don't work on, or sorry, it tells us in the problem because it's a 5-day work week. So Saturday and Sunday, no payments there. Okay, these employees don't work on those days. Okay. Then we have the 29th, the 30th, and the 31st. Okay, that's when our period ends. Our period ends on the 31st of October. Okay, it starts on the 1st and then it ends on October 31st. Uh, that was artificial time periods we were talking about, remember? And then for November, it starts on 1st and ends on the 30th. Okay, but we already paid for the 26th, but we still have 3 days to account for. 3 times 400, which is the 1200. We still have to account for that, so that's our number, okay? For $400 for each one of those days. And we have to do an adjustment entry on the 31st to remind ourselves that we owe these employees uh, um, three, 3 days worth of work from the 29th to the 31st. Even though we're not going to pay it on the 31st, we're going to pay it on November 9th, right? November 9th is the next pay period, but we still have to accrue it just to remind ourselves. So we open up, or we do a journal entry, and we book a liability for that 1200. It's going to be wages and salaries payable, or salaries payable, whatever you want to call it, or wages payable, go cray cray. And that's going to be a liability as a credit. Okay, now your debit is going to be salaries and wages expense. Okay, so you book an expense, and then if you had paid this in cash originally, okay, um, then it would be cash credit. Okay, but this is an adjusted entry. Okay, you haven't, it's not paid date yet, so you don't have to pay it in cash on the 31st. You just wait until the 9th of November to pay it, and then you eliminate the liability and you'll actually credit the cash itself. Okay, so let's go through the basic analysis. The expense, salaries and wages expenses increased 1200. Okay, good. The liability account, salaries and wages payable is increased 1200. Good. Okay, you can basically skip the basic analysis and equation analysis if you just do the journal entry. If you're that advanced, okay, you do it automatically. We're just writing it down here for repetition. Uh, you know, just to make this stuff stick, right? Equation analysis. What increased? A liability account increased, and an expense account increased. Salaries and wages expense. Again, don't be confused by the minus sign next to the 1200 under stockholders' equity. This is for the totality, okay? So this salaries and wages expense is going to be subtracted from stockholders' equity. That's why they show it as a negative here, okay, just to keep that accounting equation in balance, the main elements in balance. Okay, liabilities increased, stockholders decreased. It's a wash, right? But normally I would like to see this as a plus, right? Because expenses did increase, but you just gotta remind yourself that when you go to stockholders equity, via the income statement, the salaries and wages expense will be decreased or come out of revenues. Okay, so that's why they have a negative sign here. Okay, hopefully that's not too confusing. Anyways, debit and credit analysis. Debits increase expenses, so we debited salaries and wages expense. Credits increase liabilities, so we credited salaries and wages payable. Okay, and that's it. As you see in the journal entry here. Okay. The journal entry is very important because it takes care of all of these. All this analysis takes care of it. If you know that debits are flush with this line in the journal, okay, the first line in the journal, first line of the second column. If it's flush, then it's a debit. You know that, okay? Then the credits are indented. That's basically your debit credit analysis and your basic analysis. All that jazz, right? And then he posts to the ledger. By this point, the ledger should be easy. I mean, the ledger, if you do the journal correct, then just transfer it to where it goes from the journal to the ledger, then you're good to go, okay? Here we have salaries and wages expense. If you don't have salaries and wages expense in the ledger as an account, then you open up a new salaries and wages expense. And then you just transfer it, okay? In this case, it was an adjusted entry, debit, and you have a new balance. Same for wages payable. Okay. Then accrued expenses is the final piece. Finally, we have examples. Okay, interest, rent, salaries, reason for the adjustments. Again, you just have to go back to what an accrued expense is. An accrual is advancement. So you are advancing the use of the expense before you have paid for it. Okay, so before you have paid for it. So wages, in that last example, we have not paid for the 29th through the 31st. So that is the need for the adjustment. We have to do an accrual to remind ourselves that we owe these individuals 3 days worth of work that they have done for us. And it's also an expense, okay? Also an expense. And that's all an expense really is. It is a decrease in an asset or an increase in a liability, okay? And then we have journal entry, debit and expense account, credit and liability account. Again, income statement account, balance sheet account is affected, and that's all she wrote. If you have any questions, just ask in the comments, okay? And then here we have a nice summary of the basic relationships. Okay, prepaid again, 4 types. Okay, there are deferrals versus accruals. Deferrals has prepaid expenses and earned revenues, and accruals has accrued revenues and accrued expenses. Okay, accounts before that adjustment, so this is why they're needed. For prepaid expenses, assets are overstated, expenses understated. Unearned revenues, liabilities overstated, revenues understated. Accrued revenues, assets are understated, revenues are understated. Accrued expenses, expenses understated, liabilities understated. And this is just based on observation, okay? You just have to go back and look at the journal entries for some of these things, okay? Accounts before that adjustment for prepaid expenses. What are some prepaid expenses? Prepaid rent, supplies, whatever, okay? So for supplies, as we took a look, the adjustment entry transferred it from a supplies account to supplies expense, okay? So if we don't do that adjusted entry, the asset supply will be overstated and the expenses will be understated, okay? So we have to debit supplies expense, so expenses are not understated, as you can see here, that adjusted entry, and then credit the asset account supplies, so assets will be not overstated. So that's it, okay? So you can take a look at this, pause the video, make sure you understand this, go back in the video to look at some of these journal entries, which these rules come from, and you will see, okay? But you have the journal entries here. These are kind of variable, like stated as in variable. But if you want to see the actual journal entries, then you can go back and do that. But that is it. In the next video, we'll probably take an example or holistic example of accruals or maybe deferrals and accruals and just again um, get this stuff to sink, be ingrained in your mind. So I'll see you in the next video, and don't forget to pay me, like, share, subscribe, and all that good stuff. Peace.